everybody, welcome to Institutional Hunt. This is my technical analysis video on moving averages. Once again, this is a simplistic and rudimentary initial video on moving averages. If you are new to trading, you're going to find this rich and full of delicious information that you can consume. If you're experienced in trading, there actually is a few nuggets that I intend to cover that are going to be pretty important just for utilizing moving averages. Make sure that you're utilizing them effectively. Either way, I just wanted to make sure that you guys understand that I'm here to develop a community, help you guys get educated as best as physically possible, and to be here to answer your questions. This is a new channel. I'm very excited to be working with you, and if you have any questions, please let me know. But otherwise, let's go ahead and jump right into it. First of all, what are moving averages? Well, moving averages, there's two types. There's the exponential and then there's the simple, and I'm going to actually cover how they're calculated. First, basically they take the close price and then they take the sum of the close prices and they divide it by the number of bars, and then it basically creates a moving average of all those closes to determine what the best, what that particular point is, or that dot plot is at that time. And the whole point was really to smooth out the market, to get a general idea and kind of make it easier to see what the market's doing in a more macro component. There are two different types. There's exponential and simple. I'm not going to go into the math of exponential, but basically exponential is pretty straightforward. The closer bars to the live market are going to be more heavily weighted than the ones in the back. So if you have 100, the first 20 are going to be weighted more important than the last 80. So that's just how the exponential works. Most people use exponential, but there is simple, which is basically just a simple division problem where you add up all the closes, divide it by the number of bars, and that's all she wrote. So simple is exactly that. It is just simple mathematics. The exponential correlates with the beginning of the market, making it a little bit stronger. The main difference you're going to see between those is you're going to see that the exponential is tighter to the market, and that's just because the closer bars are weighted, so it just hugs a little bit closer. It's why a lot of people use them. The common types of exponential moving averages used, mostly exponential. There is one simple in here actually. It's the 200 EMA, and that is your general trend line kind of identifier, just to let you know, hey, where's the market going? Is it up or down? If the market's above the 200, it's going up usually. If it's below the 200, it's going down usually. There's the 255 EMA, which those are incredibly useful for determining market speed. And just determining how strong the market is at that time. They also do have a cross that they're useful for. If you see like a 2155 cross, that can be a little bit of an indication that the market is going in the direction that you're intending to go. Or if you're looking to sell and you see the 21 cross down through the 55, that could be an indication that there's a trade there. Realistically speaking, though, I don't use moving averages in that way, though. So I use moving averages to determine speed and momentum and trend. But 2155 is one that's very commonly used, or at least right around in that area. And then there's the 5 SMA EMA, and this is a momentum indicator. It's going to let you know it's real tight, real close, real time basically, and it's just going to let you know how fast the market's moving and if it's got a lot of momentum behind an action. There's a lot of space between the 5 SMA and the EMA. That might be a good indication to jump in, or the last little nugget of information you need to say, okay, I'm all about this trade now. So moving on to why do you want to use them? Because everybody uses them. I'm going to hammer this as many times as I physically can in every single video. The more that the general population uses something, the more effective it is. So almost everybody that trades has a 200 exponential moving average on their chart, which is the reason why you'll see it bounce right off an exponential moving average a ton of the time, because people use those as indications on a consistent basis. So you want them on your chart just because everybody's using them. You don't, I leave my moving averages on there all the time just because they help me kind of get a quick little snapshot and everything else. Obviously, I don't just use moving averages. You need to understand the fundamental backing behind any currency before you make any trade, and then you need to wait for the right position. But the moving averages can really help you take advantage of a full trend and everything else, and that is because they can signal a trend change, they can signal a trend direction, and they can kind of tell you how strong that trend is. And I will show you exactly what I mean by that in a moment whenever I do a live demonstration where I just go through and find, some opportunities and point out what I'm talking about. That is going to be wherever they'll give you that important insight into the market itself. Because sometimes you're in a trade, and the most important component in a trade, let's just say that, you pick winners all the time, but you close them at 20 pips. Well, that's not good, because eventually you're probably going to end up losing money. You really need to run your trades to your targets. And if they're not hitting your targets, you need indications that maybe it's time to get out before it gets to your target. Now, of course, you have to take into account, what time frame you're on and what time frame the signal was on. If you're seeing an hour-long time frame signal, you jump down to the 5-minute chart, and then you're concerned because it just crossed the 200 moving average. That's not how you're supposed to be doing that. But the speed of the market and determining what the momentum and the speed is with the 2155 and the 58, that's going to be useful in determining whether or not you should be sticking around in that trade or not, because most of the time you want to hold your trade as long as you can. You want to rock it to the end. So without further ado, I want to go ahead and give a quick little live demonstration of my moving averages, how I use them, how they're effective, how they can give you those insights into the market, and just the general use for them, how I use them, and we'll kind of go from there. So thank you very much. I'll see you in a second at the live demonstration. Okay, so here is my chart right now, and actually you can see I have a position open that I was interested in for a while. So I actually didn't use moving averages in this instance, though in retrospect I actually should have been paying attention to them for a few reasons. And I went ahead and marked a few things that you probably saw in the actual intro video itself, but let's zoom in for a second. First and foremost, I want to talk about the 200 moving average. That's this little guy right here. And it's not a little guy, it's the big guy. It's the one that everybody uses, everybody's paying attention to. As you can see, there's a nice little kind of general rejection off the line. Once again, that's because tons of people use it, so that's going to be why people are paying attention to that line. They're defending that line. They're thinking there's no way it'll go below that. And then it does, and people lose their minds and sell, sell, sell. And then you'll see these really fast, really quick moves and stuff like that. So that actually, this line, that's not the only reason why it ran super fast below that. This is actually a huge carry trade that people were running for a while from here to like here. And then now it's losing its steam almost entirely. So people are starting to panic a little bit and exit and unwind that. But carry trade is a whole nother thing. So don't worry about that right now. This is basic technical analysis. But basically, in essence, first and foremost, and this isn't a great example because, well, actually, it is a perfect example, but it's not a great example for when you would use a momentum indicator. But here's my 5-8 right here. You can see it's got a nice little bit of distance between that, showing that the market's going at a crazy momentum, obviously. But, on a smaller time frame, you're seeing this open up as it breaks through, the 200 moving average. That can be a great indication that things are going well for you. And then we have the 200 and the 55, which is going to determine the speed of the market. Now, here is a very interesting thing. There's two things that I utilize these for. Obviously, I have a general cross. The general cross is useful in certain circumstances just to let you know that it's starting to get into a consolidation phase of some sort. It doesn't necessarily mean that you should be, selling or buying or anything else like that, but it does tell me that the market is tightening back up and it is time to pay attention, or maybe move your risk capital to another asset while you're waiting for the market to loosen up a little bit. But right here in the moving average 21, you'll see this little curvature right here, right on that red line. Now, whenever the market is close to the red line or respecting the red line, it's letting you know that it's moving pretty quick and that it doesn't really have any, and especially if there's a lot of space between these, it doesn't really have any signs of slowing down at the moment. If it bounces legitimately off of the 20 off the 55, that's going to be a different story, because the 55 bouncing off that forecasts a double bottom or a double top depending on what you're seeing. So for instance, I don't think you can see this on the 4-hour chart, but on the 1-hour chart, I believe this currency actually had a forecasted double top a few times. Here, let me show you on this chart. And this one's a little bit more messy because it's got my pivot points on it, so I apologize. But take off the forward motion. Okay, so right here, this was whenever things started to signal trouble, okay? Right in this area, because we've got this, and it's respecting the red line. Boom, boom. Everybody's like, market's moving fast, market's moving fast. Breaks the red line considerably, gets to the blue line, and then holds. And then you see it push back up. Anytime you see this rejection off the blue line, that does not mean everything's hunky-dory and that the market's going to continue on. That actually, in a lot of instances, not every single time, but most of the time, it predicts a double top. And lo and behold, we get a double top, and then you start to see the red cross, and then you start to see these failures here, and then the market starts to get into its consolidation phase, and then boom, 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 boom. So it actually ended up being more like a triple top in this instance, just because, you know, it was a pretty serious carry trade that people were, you know, defending a little bit, trying to get into as best they can. But even still, those are the main uses for the you know, moving averages. You know, to cover it again real quick, you got the 200 moving average, which is general trend direction, just giving you an idea of what's going on in the market. There is the 21 and the 55. Those are going to be for determining market speed and you know, just keeping you in the trend for as long as possible. And then there's the momentum indicators, which can be used on, I usually use them on a lower time frame, just to give you an idea if it's bursting through a support level or something, and you see a wide separation in that might be a great time to go ahead and jump into that trade. Either way, I just want to thank you very much for taking the time to jump on and come into Institutional Hunt. You know, I'm going to be creating live daily planning every single day from 4 to 5 Central Standard Time, because I'm based out of Texas. And basically, I'm just going to be running that right after the close of the market, wherever we look at the economic calendar, we go through the next day, and we say, okay, what's my plan? Where am I going to allocate my risk? And what trades am I going to take ahead of time? We put our alerts in for any trades that are potentially going to ring off, and then we jump into the market and we wait. And then in the next day, we know what we're doing. Nobody's, you know, stressed or concerned. If the market does what you planned that it was going to do, then you take those trades. If the market doesn't, then you don't take those trades. But it's all about planning, rotating through the market, and going in that direction. So either way, I hope you join for that. I'm going to consistently doing that, you know, Monday through Friday. So let me know if you have any questions, concerns, issues. If you do anything like that, put a comment down below. I love comments. Comments would make me so flippin' happy. If you thought this video was fantastic, put a like on it. That'll make me happy too. And if you want to make me ridiculously happy, subscribe for more content. You'll get the daily planning content, which after I finish the live stream, obviously it'll be uploaded to the actual YouTube website, so you can go back and view it at your leisure. Either way, thank you very much for coming in, taking a look at the at my YouTube page. If you have any questions, please let me know. Otherwise, thank you, and I will see you in the next video.